Hi, investor.
Hi, accountant. I saw that my ROE, the return on my money, is going down. Can you explain me?
Yeah, of course. I'll explain you what return on equity means. So your return on equity has been decreasing, right? And there's quite simple explanations for that. Return on equity consists out of three different parts, and it's a measure to assess a company's ability to create shareholder value. It is an indicator that gives you, as the investor, a sense of how good we, as a company, are at providing returns on your invested money, your equity, as you said. To give you a better understanding of what return on equity actually means, I'll break it down for you. So first, what needs to be taken into account is the profitability. It's measured by the profit margin. The second measure that goes into return on equity is the efficiency of our company, measured by the asset turnover. And the asset turnover ratio shows how effective we as a company are at putting our resources, such as machinery and buildings, to work. The third factor that's need to be taken into account to explain return on equity is the gearing. Gearing is what simply shows the proportion of our resources that is funded through debt. For your better understanding, I'll break down these three factors for you.
Thank you.
So the first factor that goes into return on equity that we want to look at is the profitability.
Does it mean the money that I'm making?
Almost. I'll explain it to you. So we as a company, we create sales revenue when we sell products. Sales revenue is the money that we make from providing our services and products to our customers.
That equals to the money I'm making.
Not quite. From those sales money, we have to deduct cost of goods sold, which represents the direct costs that are associated with the production of our goods. This includes materials or direct labor, so the people that actually manufacture our products. The second factor, or the second measure that needs to be deducted from our sales revenue, are our OPEX, our operating costs. This includes all other expenses related to the daily operations of our business that are not direct production costs. Typical OPEX items include administrative expenses, marketing costs, research and development costs, rent, utilities, or salaries for non-production staff, like myself, an accountant.
And the electricity that I am paying for.
Yeah. And if we deduct cost of goods sold and OPEX from our sales revenue, we get a KPI which is called EBITDA, earnings before interest, depreciation, and amortization. It reflects our profit that we make from our core operation, and it shows our ability to generate earnings from our regular business activities without the influence of our capital structure, tax rates, or non-cash accounting items.
So what money I'm making?
We're still not there yet. Moreover, companies in different industries and in different countries may have different capital structures and tax rates, which can make comparisons difficult. Therefore, we use EBITDA to normalize our profits and to make them somewhat comparable. From the EBITDA, we gotta subtract a few other expenses like tax and interest payments, and then we get our net profit. Net profit is the money the company is making within a year. It's the final earnings after all expenses. So we have our sales revenue, deduct our expenses, and then we receive our net profit. It's the source of dividends that we pay to our shareholders, such as you. And it's a source of the funds that we retain to reinvest in the business. A healthy net profit allows the company to reward shareholders and invest into future growth. So you as a shareholder can probably get more dividends in the future. And now the measure that goes into our ROE is not the net profit, it's the profitability. So what does that mean? The profitability in terms of the profit margin is simply the net profit divided by sales revenue. So this means how much net profit are we as a company making for every pound or every dollar we create in sales revenue.
That makes so much sense.
Or the first factor that goes into our return on equity.
Hi, accountant number 2. Can you explain me what is this asset turnover? Does asset turnover?
Well, the second part of ROE is asset turnover, which measures how efficient a company utilize its assets to generate revenues. And asset acquisition is financed through two main sources, internal and external. So for internal financing, namely equity, often comes from retained earning or shared sold to investors. This represents the company's own resources and signifies a long-term financial commitment. On the other hand, external financing primarily consists of liabilities, which includes debts that require regular interest payment and the eventual repayment of the principal amount. Additionally, there are operating liabilities such as account payables and accrued expenses, and these liabilities arise from business operations and may not be intended as financing sources, leading to a considerations of whether they should be included as part of our external financing. So to obtain a clear picture of total financing that used for asset acquisition, it is logical to consider capital employed, which include both debts and equities. And there are two main methods of asset acquisitions: capital expenditure and changes in working capitals. CapEx involved investment in non-current assets like PPE, and meanwhile, working capital is derived from changes in net operating assets. And the efficiency and effectiveness with which these investments are transformed into future economic benefits determine their impact on asset turnover. A higher future economic benefit per unit of additional PPE or working capital translated into increased asset turnovers, and conversely, a lower benefit translates to a decreased turnover.
Wow, that makes sense. Now we can understand what is asset turnover. But what is gearing? Is it related to cars because of gears?
Nope. Well, the last of three factors going to return on equity is gearing, and gearing is a relatively simple ratios showing how much of our resources are funded through debts, and therefore we simply divide our assets by our equities. Although gearing is just a ratio of two balance sheet items, it has major implications on the companies. On the one hand, high gearing means that high liability, which means we most probably have to pay a lot of interest, and to be able to meet our interest payments, we have to create a relevant amount of cash from our core operations, and this metric is called operating cash flows. If we wouldn't be able to generate sufficient operating cash flow, it would mean that the business is not sustainable and is highly likely to run out of cash in the long term. And on the other hand, a high gearing can be good for you as an investor, since it means that we are able to put a lot more resources to work than you as an investor were able to fund.
So now I understand that profitability is the profit that I'm making with every pound of sales that I'm doing. Efficiency is something how efficiently I'm using my assets, and gearing is relating to debt, on how much debt I'm getting. So that makes sense that if my one of these factors are badly performing, that's why return on my equity is going down.
Hi, investor.